And so as we think about opportunities, we also think about risk. And there were some pretty public defaults that took place emanating from corporate private credit last year. Alyssa, I'd love to turn this to you from your seat. Is this representative of more stress to come, or was it more of a red herring?
So I think what it was is that we've been in a period of elevated interest costs. And I think that when you are in an environment where base rates are high on floating rate borrowing, which is most of the case of what we saw where some of these defaults occurred, you have the combination of loose underwriting standards, higher interest costs, and then an environment that we really haven't been in before where policy is changing at such a rapid rate that businesses are not really prepared for how policies are changing. And so in the cases of some of the defaults that we've seen so far in 2025, it was the intersection of loose underwriting, a lot of capital chasing very few receivables, as well as massive changes in policy. One was a case of changes in immigration policy, and the other was directly attributable to changes in tariffs and how that flows through to consumer receivables. So I'm not surprised by it. I think that we actually have been in a fairly elevated default environment in the levered credit markets. Bank loan defaults are around 5% right now when you include distressed exchanges. That is, I think, to be expected when you're 2 years out from the start of a hiking cycle.
It's totally fair. And Liz, you're in a market that's at historic tights in investment grade markets, certainly in public credit. Defaults don't seem to have been elevated in those markets. Are you observing any cracks within your marketplace?
I don't think we're really seeing any cracks, and I think I would also just differentiate the investment grade private credit from other markets just in terms of some competitive forces. Very often the issuers in our market want to come or need to come to our market and don't have choices. So we don't have that competitive dynamic in terms of covenant light types of situations. Our buyers, our instruments are typically longer term and buy and hold. All of the documents are bespoke. They're negotiated for every single transaction. And so with that, and knowing that they want to actually hold these for what could be a long period of time, negotiating those covenants, that's part of that trade-off in terms of what our investors need versus being able to give those lenders, the borrowers rather, the opportunity to actually go and have somebody other than their banks in terms of a capital markets partner, or being able to go longer than the banks are. That's part of that trade-off.
Makes sense. And Ravi, flexibility I know is a really important part of your market, and real estate has gone through some pretty turbulent times in the last couple of years. Have we bottomed out?
Well, we've had a fair amount of repricing and the fundamentals across most sectors. Obviously, you hear about office. There's been a structural shift as to how we use office today and going forward. But other sectors like housing and logistics and industrial are fundamentally sound and or have tailwinds behind them. So couple that with the fact that we've had these repricings, I think it's credit safe environment to pursue lending in real estate debt, especially relative to other markets. We are collateralized by a hard asset. So if you can lend at an intrinsic discount to the replacement cost of these assets and their long-term viability and use, you can feel pretty good as a lender.
You talked a little bit about industrial, and I don't think we can talk about any market today without the infamous two-letter word, AI.